Okay guys, welcome to the Market Maker Collection video series. This is the first in a series of 12 videos. We're going to be going over a lot of material in the next 12 videos. There will be a rehash of a lot of the classic ICT material, and there's a further amplification of some of the things that we have just glossed over. I know many of you probably think it's a lot of information, and it is a lot of information that was covered over the last 4 years, since 2010 when I stepped on the scene as a foreign exchange mentor and teacher, or quote-unquote guru. the the material, we're going to be actually going into a lot more principle-oriented and step-by-step approach. This is going to be one of the most broad brush teachings in the series, but it is one of the most important because it ferrets out a lot of the explosive price moves that many traders are caught off guard by. Or if you're looking over your charts over the, like for instance at the time of this recording, we're drawing near the end of 2014, and many of the stellar moves of the year, okay, are perplexing many neophyte traders. And some of the guys that are actually been trading for a while were caught off guard by some of the monster moves that we saw this year. If you've been a part of the ICT camp and some of the live reviews and market commentary and videos that I put either on my YouTube channel at Inner Circle Trader or at my website, obviously the innercircletrader.com, there's been a long history of calling these major moves into the levels they traded to throughout the year, well in advance before they actually started doing it. It's important to understand we had a monster bullish rally in the dollar index in 2014, and we called the low in the dollar as it happened, and I'm going to go over some of the details as to what led to my analysis in that and what I do on a quarterly basis and a annual basis with my broad overview of market analysis. And I call it the macro simply because it gives me the biggest picture as it relates to the financial markets. Not just simply the foreign exchange markets, but also equities and commodities. So let's get into this and start breaking down some of the insights that I would like to share with you now. Okay, the interest rate effect. Now, if you have gone through some of my previous series, such as the Trading Plan Development series, the Scout Sniper Field Trading Guide, and the Precision Trading series, and all of the what every new and or aspiring forex trader still wants to know video series and individual modules, you know that I am a modular thinker. In other words, I like to look at things on a modular scale. Small little bite-sized pieces, okay, will eventually break down and disseminate the information of a larger whole. One of the conundrums that traders come against in their trading is, where is the market going? Okay, and you'll have a class of individuals that will view the market in the form of a fundamental aspect, and then there are pure technical analysts or price-based trading. And I lean more towards the technical aspects of trading simply because in my limited capacity as a human being, I readily admit that I am not astute as it relates to fundamentals. I believe there's so many things to keep up with. You never really get a full grasp on what it specifically is that's going to call the turn in the marketplace. Now, I will admit there are certain market drivers that you can focus on, okay, and when the central banks are you know, exercising monetary policy and changing, okay, the masses, okay, or the sentiment in the marketplace, because that's who's driving price anyway. It's not your dealers, it's not the small middleman banks, it's not your brokers, okay, it's the central banks. Now, analysts and teachers and mentors out there like to muddy the water and call all these little subordinate entities into the fray, but it's the central banks. Okay, it's their casino, it's their house, it's their rules. If they want a currency to go lower, they'll devalue it with several means of doing so. We're going to show you one of the ways that you can gauge without having to refer to interest rate differentials. Okay, now I'm not going to disparage the study or the importance of interest rate differentials because they do have its place in the marketplace. But I'm going to give you one of the truest forms of understanding how the market works, okay, as a whole. Okay, um, when you rub elbows with folks that are actually on the other side of large funds, okay, or provide the liquidity in the marketplace, it just by default you pick up on a lot of things that the general public just doesn't pay attention to. Um, you don't see a lot of books on these types of concepts that we're going to be talking about in this particular series, and that's why it's unique to me. Okay, I'm quite certain that there's going to be a lot of folks that will watch these videos and invariably create their own little teachings around it and change the names of it because it's going to be proven very, very effective, and it's going to smack the retail industry in the mouth with a lot of the clarity that it gives. Understand this. What I'm sharing in this video series, it comes with a great deal of adversity in my own life because the entities that divulge these um, concepts to me, because not all of them are my babies, if you will. They're not my creations, if you will. Some of them were observations that I've seen in price action and were later confirmed by participants on the institutional level. And then there's certainly other things that we'll talk about, such as the central bank dealers range and later modules in this series. All those types of things were actually given to me. They were not brainchilds of ICT. And where credit is due, I will certainly do so. But certain institutional tools and concepts will absolutely have to be anonymous simply because of that's just the way it's going to have to be. Not because there's somebody out there that has a course or book that has it, okay? Because if they did, I'd save myself a whole lot of work and just say, hey, look, I like this book or that series or that particular mentor, and go read their um, material that you could purchase or even get it for free if that was the case. But it's just simply not out there. Okay, I've been ripped off by a lot of folks that claim to have insights with the market maker, quote unquote, concepts, but you're going to really get the nuts and bolts of what they do and how they do it and what's their motivation behind all of it in this series. And again, there's no rehash of anything out there on the internet. It's completely unique to me because it is coming from an institutional aspect. Okay. Now, what is the interest rate effect? Well, it's simply an understanding of the interest rate market, such as we're going to focus on the 30-year treasuries. Now, the 30-year treasury, okay, is a instrument that is tradable in the futures market. Now, we're not going to be talking about commodities so much in depth in this particular video here, but we will relate to them as we go through the entire series as it deems necessary. When we look at the market as a whole, and I'm talking all asset classes, I'm talking equities, currencies, commodities, even agricultural and foods and softs as it relates to commodities, and energy prices like oil, gold and silver as precious metals. All of those particular markets are influenced by interest rates. Okay, and one of the truest forms of understanding the interest rate driving force behind the equities and asset classes that we just mentioned is just simply looking at the 30-year treasury, because the 30-year treasury gives you, by definition, one of the longest term primary macro drivers as it relates to interest rates. It's not a short-term vehicle. It's a long-term 30-year treasury. Because speculative capital looks for yield and it will always seek yield, the fundamental basis to investing is a long-term approach. Now, I would counsel folks not to have that view as a trader. I think you should be more speculative, getting in, getting out. And there are times when you can buy into a long-term position and hold on to it for many months and then get out. Okay, and sometimes in many times, many years can be the end result of a long-term position trade. For me, I think 3 months is about as long as it's going to be. I just can't bring myself to hold on to a position longer than that, simply because there is a quarterly effect that we'll talk about in this video module that is crucial to you in understanding how the money flow system works as it relates to interest rates and all of the asset classes. Now, the charts that I'm showing in this particular video, and I may refer to them later on throughout the series as I work towards building more of the 12 in the set. Whenever there's an image or a chart that is obviously not an MT4 chart, I will obviously be pulling it from barchart.com. Now, barchart.com is a free website you can go to, and you can use their charting services to get the same charts that I'm showing here. Now, the T-bond or Treasury bond on the left here is, again, a measure of the 30-year benchmark interest rate. One of the coolest things I learned from my mentor, Larry Williams, okay, is the influence of the bond market. And the beginning points of all of this, I think one of the discoveries that he hinted at in his early work, and I'm talking about the inner circle workshops that he had and went out throughout the United States and in certain parts of the world. He taught a specific style of trading, the S&P 500, on a day trading basis. And he discovered in his own trading that if he incorporated the trend of the Treasury bond market, okay, in the form of looking at a 9-day moving average based and plotted on the close. If he wanted to be a short seller on the S&P 500, he would have to see a uptrending 9 period moving average. It was a simple moving average. It wasn't even exponential. It was plotted on the closing basis. And by doing that, that revealed to him a rather astonishing phenomenon, that if he was looking at the market in relationship to the bond market, suddenly his trades had a higher level of efficiency and profitability. So I wasn't surprised when I got with a group of institutional traders that used the same insights as Larry hinted at back in the mid to 80s, early 90s. Now, obviously, I got involved in trading in 1993. I started my studies as a trader in that year and began live trading in 1994. Ran my meager $2,600 up to $832,000 inside of 9 months, and thought I knew everything. But suddenly, as we got closer to the year 2000, the bottom fell out of the marketplace, and suddenly I needed to learn how to trade, not just simply buy in a bull market. I learned, okay, there is a characteristic of price action being manipulated and controlled, okay, by the interest rate market. And I also specialized in trading the bond market. And they're not going to talk about every aspect and facet to bond trading here. It will be incorporated in the short-term trading module in this series. But we'll talk about the influence that the Treasury market has on, for instance, this study, the dollar index. Okay. I think if you just take a quick glance and look at what we have here in comparison, if you look at the lows in here, okay, moving higher and higher and higher, okay, obviously one could argue, okay, this is an uptrend. Without having to look at any other scale frame, this whole thing here, as it relates to the bond market, shows a clear higher high, higher low, okay, and that, to me, without relying on the basis of a trend line, because I don't like trend lines. I don't like diagonal support and resistance, or at least implied support and resistance on a diagonal basis. I do trust horizontal support and resistance, okay, and because they're price based, and you can clearly see where price has turned in the past and acted as support and resistance, and wherever those particular price points were in the past, they will certainly have an influence on price as we go forward and trade back to those levels. I want you to look at the year 2011, okay? And I want you to look at the relationship between the lows in the dollar, which is on the right-hand side, and also the lows that were made in the Treasury bond market. Notice, if you will, that as the dollar index was dropping and making a lower low going into the spring and early month of 2011, the Treasury bond market, while it did initially start off in the beginning of the year dropping lower, it made a higher low. Okay, and that's seen right here in respect to the lower low that was formed here in the dollar. When we have something like that, while the underlying pinnings of the market in the bond market is bullish, okay, we would anticipate seeing a rally in the Treasury bond market. And when that happens, what will happen as a result, the bond market will act as like a magnet, if you will, okay, and draw an upward pressure on the dollar index. Okay, so as the bond market rallies, what that'll do is it'll give incentive for our greenback, or the US dollar, to rally higher. When this takes place, what that will cause is a risk off scenario. Now, a risk off scenario will be in the form of lower equity prices, lower commodity prices, sometimes depending upon inflation, deflation periods. And for more insights on that, I would advise you to go back and look at my major market analysis video module. That will actually dovetail nicely with this particular teaching here. But if you are seeing a dollar-based rally like this, it's going to be supported by the bond market or the treasury market rally. And when you have that, you can trust the buy signals in the dollar. And you can also anticipate further upside or continued upside in the dollar. Now, what will that translate in terms of markets like fiber, which is Euro USD, and cable, British Pound USD? What would those particular pairs be doing at that same time? They will be a mirror image of what you would anticipate in the dollar. So if the dollar is expected to rally, we're going to see weaker prices across the board in foreign currencies, such as fiber, cable, and eventually even others in the majors like Aussie, New Zealand, Canadian, and Swissy. Okay, so and we'll show some of those later on when we talk about relative strength analysis. And again, it's not going to be the RSI, or relative strength index, that worthless indicator that traders like to put on their charts. That has absolutely nothing to do with real trading. Okay, what we're talking about in this series is not going to be hinging upon indicators based on math. If any mentor or any quote-unquote teacher in trading, whether it be forex or commodity or stock or whatever, if they take your eyes away from the price chart, whether it be below or above it, to look at some indicator, do not have faith in that. Have faith in what is being revealed in this series, because it's all about price. Price is king. It absolutely is. And there's nothing you're going to be able to do to argue against that, because indicators are always going to be looking at the left side of history. If you look at price, that's going to give you the only beneficial or prognostication of future price results, okay, or actions, if you will. So now, looking at 2011, we already see that the bond market had come back down into an old area of consolidation. Now, we also learned in the precision trading and Scout Sniper series that we view consolidations as equilibrium. Now, when price moves out of equilibrium or small consolidations, they will have a tendency to pull back into those consolidations and reinvest, okay, in the direction of the move away from it. We see the dollar index in 2011 go into a consolidation. Now, there is a little bit of a lag sometimes as it relates to what we're describing here, and that's not uh, a, a weakness. That's not a shortcoming in the understanding. Because we are looking at a higher level long-term macro perspective, it's beneficial to you to understand it like this, because it's not going to give you this rush to be able to, make a decision right away. It allows you to look at the price action on a daily, weekly, and monthly, and maybe 4 hour, and discern where it is that you want to be taking your trades based on the understanding of what we're sharing here. Okay, and I counsel you to use this in a demo account to prove it to yourself that it is in fact exactly how the markets work, and there's no fluff in it. There's no retail influence. Absolutely pure price based and quote unquote fundamental driven. Okay, now I'm not a fundamentalist, but I believe that interest rates are the core of all fundamentals. And if you understand where the interest rates are going and where they're pulling price, you'll have 80% of the battle licked. Now look at what we have here in this consolidation. Okay, we have a quick move out of the consolidation or equilibrium, and price comes back down into it. Okay, you see that? We have the similar effect here in the bond market. The price moves away, comes back inside of the consolidation, and we start to see a rally up in treasuries. That will incite a dollar-based rally. Look at your futures charts and your forex charts for currencies, and you'll see that that particular time, which is late 2011 in the fall going into the winter months, you'll see that there's absolutely beautiful sell signals in all of the majors as it relates to currencies, because it was a dollar-based rally. What was the fuel behind that? It was the rally in the treasury bonds. Interest rates, okay, were driving that particular dollar-based move. During the 2012 going into 2013, we had a rather large consolidation in the treasury bond market, but we did start to see a breakdown in market structure. We saw a break in structure here. This low here was taken out. Market structure has shifted, come back up into an order block, and started to move lower. As the treasury bond market started to slip lower in here, as we see, moving up into his order block here, starts to slip and trade lower. Okay, behind this chart I have an overlay so you can see clearly that while the dollar did try to make a rally in here, it was quickly staved off and had to go back in line with what treasury market was doing. And I'll show you in a moment. I'll flip this this overlay in a moment where you'll see the dollar above the treasury bond market. But you can see the tug of war that takes place. Okay, when the dollar wants to run another direction, the bond market is really calling the shots. It's on a long-term basis. You can't argue with what's being shown here, and this goes on all the time on a macro scale. Now, this can also be viewed on a short-term time frame, but I'm not going to tell you to look at a 5-minute chart and compare the bond market against the dollar. Okay, I'm not going to do that. On a daily chart and maybe a 4-hour chart, that's about as low as I would go for any short-term divergence or confluence of directional premise based on what we're showing here. Now, if I haven't lost you, okay, you should understand what we're showing here is the tendency for the bond market to steer or drive the direction long term for the dollar. Now, why is that important? Because if you're going to trade currencies, the dollar is king. Now, you could argue and say that may not be true, but as it is right now, at the time of this recording, it still is the Mac Daddy. So it's going to be the currency that all others are weighed against. And if it's going to rally, it's going to put a lot of selling pressure and make a lot of heaviness come in the way for all of other foreign currencies. If you'll see the relationship of the dollar in here, okay, you can see eventually as the bond market started selling off, even though we were trying to rally in here, it just could not get any upward momentum and had to fall back in line. Now, eventually, as the bond market behind the scenes of this dollar chart was having a stellar rally in 2014, that was the catalyst why we were anticipating bullishness right here on the dollar. Now you can go back and look at Twitter. It's still on Twitter, and look at all of the market reviews where we were talking about the dollar index being bullish, and therefore all of the foreign currency pairs such as fiber and cable and the likes, they would be weaker as a result. And this is one of those cherry opportunities to see how we called all these things in advance, and they were astronomical price moves. I mean, we're not talking about 100 pip moves here, guy. We're talking 1,000 pip moves. Okay, I mean thousands. It's not like a little bitty 25 pip or 75 pip a week on target like you hear me teach in the sniper course, which is my preferable way of trading, really. You just real bread and butter type trades, get one per week and be happy with it. If you're going to be a really dynamic trader looking for explosive moves and making your directional premise a lot easier, if you start on the macro level like we're discussing here, it gives you a lot of trust, if you will, in understanding what side of the market you need to be trading. Now, can you trade against this? Absolutely you can. But my question is if you're just learning how to do this, why would you want to do that? Why would you want to stand in the way of that? Because it will give you immediate feedback. When you're right, it will be quick. Your trades will turn in your favor right away. You'll cover the dealing spread rather quickly. When you counter trend, it's just it goes against the grain. And if you're a developing new trader and you're not really versed in price action, I would counsel you not to try to do that. I know there are traders out there that can work inside of ranges and intraday and trade their volatility and do very well doing that, but that's not my forte. And I'm not trying to make a cookie cutter ICT model for everyone to follow, but I'm going to give you this as a general rule of thumb. If you trade with this understanding in mind, focusing on the overall macro trend of the 30-year Treasury bond, it will pull and tug of war, okay, and get the dollar index to eventually come in line and work in the direction that the bond market has traded in. And I'm expecting you to not take my word for it. Don't take my word for it. I want you to go and you study your charts and see for yourself that it's really there. Does it sometimes cycle in and out on minor aberrations in price action? Sure it does. But when that happens, there's also a confirmation of a major retracement or correction in the marketplace. And you can see that taking place here where we saw the lower highs in the Treasury bond as we were moving higher in the dollar. Okay, and there's going to be an opportunity in that if you understand how to use all the concepts we're going to be sharing in this particular series. Now, focusing on the Treasury bond market a little bit more clear, we're looking at again 2014, and we're going to be specializing our view on the market as a whole with this understanding that we have price moving back into an old area of consolidation. Now, inside of consolidations, we understand this is equilibrium. Price had moved out of that rather sharply right here. Okay, when that happens, there's going to be a lot of orders still residing in around this area. Okay, around this area right in here. We talked about order blocks in the two previous series, that being the precision trading series concepts and the scout sniper trading series. And with that understanding that we released to the retail world, order blocks can really help you zero in on particular levels of interest for institutional traders. Retail traders do not move the marketplace. It's going to be large institutional flows, that being the banks and the central bank level. It's going to be the smaller banks and large institutional funds. We as retail traders cannot move the foreign exchange market. Okay, I know a lot of you guys think I have great influence over the marketplace, and if I get in, I'm going to move it around, and I can tell you that doesn't happen. But years ago, when we were in the commodity market, when I was posting trades on the S&P and bond market, you would see fluctuations immediately as I posted my entries and adjusted my trades accordingly. But that's not going to happen in the foreign exchange market because it's simply too vast of a marketplace for little old ICT to have any influence in terms of short-term fluctuations. But looking at what we have here, at the beginning of 2014, we had traded back down into that 128 for a rather easy way of viewing an anticipated bounce in the Treasury bond market. Now, I'm not going to do it here, but if you plot a Fibonacci on the overall price swing that took place in the middle of 2011 to the retracement down into 2014, or the very last week going into 2014, that comes around what we would understand as a typical ICT optimal trade entry. It did turn on a dime around that big handle 128 and started to rally. Knowing what you know already about my insights and my tools and concepts of optimal trade entry and following order blocks and retrading back into them, you should be able to see a lot of that taking place throughout the 2014 period of this chart. As it relates to bullish prices in the bond market, we would be anticipating eventually the same thing unfolding in the dollar index, and we'll probably go into greater detail in examples, maybe through Twitter at the time of this release here, as I see examples of opportunities where it could be seen on other shorter term time frame charts. I'll do that as well. But I'm trying to keep these particular videos concise and short, around about the hour mark, and we're already about 35 minutes or so into this one. So I want to kind of like give you again a broad brush idea, but when we go to the last video in the series, when we talk about mega trades, we're going to revisit this whole idea and build on it with much more greater detail and precision as to what we're doing. But for now, I want to get you accustomed to looking at the bond market on a grand scale like this, or a macro view, to give you the basis for understanding where the money flow is going to be pulling the dollar index. Okay, because if the dollar index is going to be muscled higher, you obviously know what the mirror image is going to be for fiber and cable. They're going lower. Okay, so now price did in fact shoot all the way up into an old high back here. What is this old high in here? Well, that's a bearish order block right there. You see that? Well, it just so happens that's exactly where it made its classic, what we call in the retail world, a double top. Double tops we don't trust. We anticipate them to be blown out. So there may be one more drive higher in the bond market that will be remains to be seen. We'll see whether or not if that unfolds. But looking at this market and then comparing it with the dollar index, you can clearly see where all this dollar strength came from. Okay, a lot of folks are saying, wow, the dollar's, really rallied. What happened? Well, now you know why. Okay, there has been this repatriotism to the dollar this year, and it's been a real aggressive bull market on the dollar, which has been the catalyst for these extremely bearish moves in all of the foreign currencies. We're going to be looking at a concept called relative strength analysis, and we're going to show you how that tool, coupled with what we have here gleaned in terms of macro insights for directional premise, focusing on the dollar. Okay, that's what we're doing here, guys. We're focusing in on the macro view of the greenback. Because if you understand what the dollar's likely to do, your currency trading with the other crosses against the dollar is so much easier. Now, will it be perfect and you never take a loss? Absolutely not. That's not going to happen. I can't promise you that. No one can. Okay, but if you understand what we're showing you here and incorporating that with your trading, it will give you a framework to know what side of the market you're going to really be pushing it and risking your majority of your risk on, In other words, if you're risking 1% or 2% in the industry standard, if you're trading in line with this understanding, that's when you're permitted to use your maximum risk leveraged. But if you're going to trade against this type of insight, you want to be really ratcheting back your leverage and keeping your trades short, sweet, and if you get a barn burner on a short-term move going against these types of flows, just be happy with it and don't expect it as the normal. Okay, so in other words, we would anticipate range expansions, okay, and big moves going in the direction of what the bond market has already established on a macro level, and you see that happening here. Looking at what we saw earlier, again, looking at the bond market, notice what was happening all in this down move here. What was the dollar index doing at the same time? It was consolidating in a rather large trading range. Notice it was not willing to give up the lows that was forming in here. Okay, if you look at market reviews, it's still on YouTube and on my website. We were talking about this level here being significant. Okay, and if it was able to break this and go lower, we would probably see a return back into these levels here. But we were more inclined to anticipate a bullish move based on the understanding that we've already shared as it relates to the bond market. Now let's look at relative strength. Now relative strength is a concept that is not unique to me. Okay, I learned this again from my mentor, Larry Williams. And you can learn it too, the way he presented it in his book, How I Made $1 Million Trading Commodities Last Year. It's a 1970s book, and I know some of you young cats that are in your 20s or maybe even younger than that now in 2014, you may snicker at that and say, well, 1970, good grief, it's ancient. Well, you're talking to a dinosaur. I was born in 1972, so while I wasn't old enough to understand or read that book or even be aware of who Larry Williams was, I do simply get every opportunity to pump his book as it relates to trading because it's so good and it's so simple. It's silly. I mean, if anybody takes the time to read that book, the understanding that he uses for how he incorporates price action, okay, and he doesn't use order blocks, okay, that's alien to him. If you see some of his trading, you'll clearly see he doesn't use that, but he looks at price in a way that helps him ascertain whether the market is under accumulation or distribution, and he does it without looking at an indicator. Now he does have an accumulation distribution formula, which I'm a fan of, but there's sometimes it just simply doesn't give you a signal. And if you can incorporate an indicator like his accumulation distribution formula, which we're not going to be talking about in this series, okay, and showing examples of, there's certainly plenty of information on the internet. You can Google it and find it for yourself. But if you incorporate that with what we're sharing here in relative strength analysis, it will be a barn burner for you in terms of validating a signal you should have already arrived at based on price action alone. Okay, so now we've already discerned that going into the middle of 2014, the bond market was in a tear. It was rallying higher, and that will in fact fuel a dollar-based rally. Looking at the July time period, compare that to the lows that were formed in May. See how we had a higher low going into July for the dollar? There's two major periods in the year that I really want you to focus on, okay? And these are one of the strongest tendencies for the currency markets to turn and make sizable moves, okay? There are, for the foreign currencies like the cable and fiber, which is British pound USD and Euro USD, when you see pairs like those trading higher going into April and May, anticipate a sell-off. Okay, I'm going to give you the clearest form of seasonal tendencies there is. Anticipate a selling or sell-off or a bear market continuation or beginning between the months of April and May. So if you block out those months and just have them on your charts always anticipating some sort of bearishness, you will have a very, very easy time finding shorts during that period. And if you're looking at it in a macro scale like this, it will give you a beautiful setup for swing trades and short-term trades, not just simply day trades. And if you do see a sell-off in the April and May time period in euro and cable and all the other foreign currencies. You would obviously anticipate a rally in the dollar. The second time of the year that has a very large influence in terms of seasonality, it is the first week of July. Now, the first week of July, I'm going to give this out there also, and you'll hear me talk about it again when we talk about commodities, because we will be doing an individual module on commodity trading and options. The first week of July, if you just look at your calendar and circle July 4th, okay, that's like a very important turning point in the marketplace. If you look at what we talked about in live sessions this year, I was talking about the tendency for the markets to make a high the first week of July. And typically around the 4th of July is when it takes place. And I specifically called out the oil market this year and told everyone that oil is still subservient to these types of influences as well. And if you look at your oil charts this year, I think you'll be flabbergasted about what you'll see. The tendency is for money flow to shift in and out on a quarterly basis. You're typically going to see a bullishness in the springtime based on the interest rate market. Now, sometimes there is a lag in that turning point. Some asset classes and some individual markets or currencies will have a lagging effect to it, but it will eventually come under pressure with this phenomenon, and that's why the July turning point will be of importance to you. Now, again, do not take my word for this. Go through your charts, historical charts this year, last year, and all as far as you can go back, and you'll see this phenomenon does in fact stare at you in your charts. Okay, I'm been widely popular for timing the weekly highs and lows based on the teachings I gave as it relates to Tuesday's London Open typically being the high of the week if it's in a bearish market, and Tuesday's London Open the low forming in a bullish condition. You have a 70% chance that that's going to happen on just like that. If you're looking at trend analysis and understanding this basic momentum, that in itself, you can make a lot of money just doing that, incorporating that in your trading. But now we're looking at a broader brush idea of when in the year, what time of the year are you really focusing on potential shifts in market structure. So now we already understand where we can anticipate future major shifts in the tide of money flow as it relates to interest rates, the dollar index, and just those two things alone gives you all of the insights that you ever need for looking for big moves, okay, in the currency markets and the stock market. Looking at the higher low formed in July, let's take a look in comparison to one of my favorite markets, which is the British pound. Notice at the same time the British pound was able to make a higher high going into July. Okay, so between April and May going into July, we were able to post a higher high. The cable, which is what we were calling all this year, was one of the strongest currency pairs to be trading on the long side. And you can clearly see the benefits of having done that going into July. It was, one of the easiest ways to make money on the long side, this particular pair. But notice what was happening at the same time. We saw the cable making a higher high, but the dollar was unable to make a lower low. That is a major footprint. That can only happen if there is a massive accumulation on the pair that doesn't follow suit. In other words, the dollar was unable to go lower. But look what was happening again with the cable. It looked really bullish. It was making a higher high. But against the dollar, it was absolutely unwilling to make a lower low. If it's unable to make a lower low, that can only happen because it's being accumulated on a long side. There was a massive buildup of longs around that 80 handle. Let's take a look at what was going on in the euro. Between April and May going into July, what was going on in the fiber? It was a lot of distribution. It was unwilling to make a higher high like the cable was. This market was under heavy distribution. I think you'll remember that there was a interest rate announcement earlier in the spring, and that was basically the top of the euro, and everybody ran for the exit ramps on this particular currency pair. But if you just simply looked at higher highs and higher lows, in the cable, you could have been lulled into believing it was going to go much, much higher. But we see here there is a major turn in the tide of the major market. Okay, and notice the high that was formed in the euro. It's in July. You see that? Look at the high in the cable. It was in July. Looking at the market like this, you'll be able to see when there's a massive distribution or accumulation when you compare it with the dollar. I call this the USDX, or dollar index, SMT divergence. Okay, it gives you a macro scale of where real accumulation and distribution is taking place, not based on some math hokey pokey, looking at the left side of your chart, what's already happened in the past. Forget all that. You can clearly see that they were really unwinding longs and just heavily selling the euro here in July. When you see that on a scale of a daily chart like this, at a seasonal time of year when we anticipate a sell-off, this will give you a green light go to start looking for sell models in the cable, fiber, and related currencies like the Australian dollar, the New Zealand dollar, the Swissy. Okay, when you start seeing these types of divergence, okay, against the dollar, at a seasonal time frame, it gives you a loaded deal for really, really easy directional based trading. Okay, because you're trading with a quote unquote fundamental driver behind it. It's the interest rate market. Okay, let's take a look at what the New Zealand dollar was doing. Look at that. It was able to post a higher high. At the same time, the dollar was doing what? Making a higher low. It was not able to go lower. See, in a perfect world, as the New Zealand dollar and the cable was making a higher high, the dollar should have been making a lower low, but it wasn't. There was a crack in correlation there, and that's like a big red neon sign, like start paying attention, because we're getting ready to see a major shift in the tides, and the money flow is going to start moving a different direction. You're going to start seeing the driver of the interest rates start muscling the dollar index, and when that dollar index moves, by default, all the other pairs are going to have to bail. Even the Australian dollar eventually had to succumb to it. And look at the high on the Aussie. Where did it come in at? July. You see that? And eventually, even the Canadian dollar posted its high when? July. Okay. We talked about these seasonal tendencies back in 2010 on baby pips of all places. I gave you a British pound seasonal tendency that I acquired back in 1995, and I still use it today, and I counsel you to go back and look at my older works, and you'll see that. It will make its way back into this series again later on, but for now, just understand that I'm not making up these seasonal tendencies because it works perfectly this year. You'll look at the template that I shared in 2010 and that I was actually utilizing back in 1998 when I was teaching on America Online commodity trading. They are just very generic turning points in the marketplace that are just always coming on, underway in the market. And if you understand how they work, why they work, and you couple that with the interest rate market, it's absolutely a barn burner. And even the Swiss franc. Now, look what's going on there. It made a high in July. Now, is it lower than the highs that were formed back in April, May? Absolutely it was. But it was also indicating it was extremely bearish. There was a lot of distribution in the Swiss franc. Now, let me ask you a question. How can you use this information? Well, if you see a currency pair that is strong against a currency pair that's weak, okay, look what you've arrived at. You've arrived at essentially what your interest rate differential charts should indicate. You're pairing a strong pair against a weak pair, and the spread between the two should increase, and therefore that particular cross should see a price advancement or a decline based on that understanding of what we just discussed here. Now, I understand this is probably a lot of information, even though I have oversimplified a lot of it here, just focusing on specific time of year and how we incorporate the bond market, what we're looking for, okay, will be in greater detail as we go into the mega trade section on the last video. So I've created the bookends, if you will, of the series, starting with the framework here, start looking like this. And we're going to end this series with how we draw all these things together to come out with some monster trades that really put pips in your account and put the whole notion of being a short-term trader or scalper intraday and not fearing holding on to a position, putting it to bed easily, and building a confidence of knowing how to forecast future price moves in the foreign exchange market. So we're going to close this video series installment here with a promise that we will be returning back to this specific concept and build on this whole framework as it relates to the dollar index and USDX SMT divergence and major shifts in the marketplace. Because if you also look at July as it relates to the equities markets, you'll see clearly that there was an opportunity to be a seller in equities there as well. Eventually the equity market did move higher, okay, but that's on another discussion. And just for just for time reference alone, I believe that we are going to see one of the worst sell-offs in the stock market that's ever been seen. And I'm putting it in this video series. It's probably not the best place to put it, but I'm only going to do it this way because it's going to be time stamped and it was given to you in advance. I believe that the Federal Reserve had given that bailout money just to with the understanding that the banks would have to buy equities with it, and that's what's been propping our stock market up since the meltdown in 2008. And there's going to be a piper to be paid, and it's going to be ugly. So enough of that. I know it's a little bit of a rabbit trail, but you got to have one in an ICT video, guys. Remember, that's always a bonus. It's thrown in there just for your benefit alone, not for me to hear my own self-talk. The next video series installment, we're going to be discussing the relationship of commitment of traders and institutional order flow. So I think you'll be blessed by that insight as well, and really put to bed the whole understanding of commitment of traders and how I use it, how I implement it, and build ideas on my trades with that insight. That will be the last, I think, of the bridge work of the macro view, and we'll start working down into an intermediate term scale with order flow and order block understanding as it relates to precision entries and trade selections. So with that, guys, I wish you good luck and good trading.